Markets are unpredictable and volatile by their very nature. They present both inherent risks as well as a possibility of making returns. Derivative instruments such as futures and options allow us to limit our risks while investing. Hello, I'm Gaurav and I will take you through the process of doing an options trade on ICICIdirect.com. If you are new to options trading, let us first gain a quick understanding of the basics. The terminology in options can be a bit confusing, so let's go step by step. An options product essentially comes in the form of a contract. The contract has an underlying asset and the contract has a strike price, or simply put, the price of the option. Options are of two types, call option and put option, and we can take a buy or a sell position in either of them. Here are the rules of the game. The buyer of a call has the right but not the obligation to buy the underlying asset at the specified strike price, whereas the seller of the call has the obligation of selling the underlying asset at the specified strike price. In contrast to this, the buyer of a put has the right but not the obligation to sell the underlying asset at the specified strike price, whereas the seller of the put has the obligation of buying the underlying asset at the specified strike price. Let me explain to you the mechanism now. It is quite simple. Let's say we wish to take a buy position on a call option. In that case, we will have the right but not the obligation to buy the underlying asset. So, if the price of the contract moves against us, we can simply let it go or refuse to buy. That's where the word options comes from. This option comes at a price which is called a premium. Premium is a small fraction of the price of the underlying. By paying this premium, we can limit our risk. Or in other words, taking an option by paying a premium insures us against a catastrophic loss. Let's look at a quick example. Let's consider Nifty June 5500 call option, which has a lot size of 50. Let's say the premium is rupees 70. If we want to buy this call option, we will need to pay rupees 70 multiplied by 50, that is rupees 3500 as the premium. But now, if the price moves adversely for us, we need not bear the entire loss. Our loss is limited to rupees 3500. So the downside is limited and upside is unlimited. It works similarly while buying a put option. It is slightly different in the case of taking a sell option on either call or put option. In the sell position, there is an obligation to either buy or sell. Therefore, a premium is not involved. However, in this case, a margin is involved and the mechanism is quite like in margin trading. Do an options trade hands-on and you will understand it very easily. All this sounds complex, only until we take a dive. That's what this video is all about. Let me take you through an options trade on ICICIdirect.com right away. Let's quickly log in with our ICICI Direct username and password. We will be taken to the equity trading page. Click on FNO and we are ready to go. Like in anything while trading with a margin, the first step is to select the product to trade on. ICICI Direct enables selected contracts under various underlyings for trading in the options segment. Only those contracts which meet the criteria on liquidity and volume are considered for options trading. You can check all the enabled contracts by clicking stock code under FNO and choosing options under the products drop down. Let's now select a product to trade on. Mouse over FNO and click place order. Enter the stock code first, and if you do not know the stock code, refer to the stock list or type the first three alphabets and choose from the drop down menu. Select options under the product drop down. Then you need to select the option type, which is either call or put as explained earlier. Let us say you are bullish on Infosys and want to buy a call option. Select it and click select contract. A list of contracts for Infosys with different strike prices and expiry month will open. Now, let us say you want to buy the Infosys call option with a strike price of 2,850 and expiry date of 30th January 2012. You can see the lot size of 125 quantity and the last traded price at Rs 41.50 for this stock option. Now click buy from the option provided. A buy order screen will open where you need to enter some details like the quantity which should be in the multiple of the lot size of the option. Let's say you want to buy 125 quantity. Now you can either choose a limit or a market order, which works exactly like in share trading. Let's look at placing a market order for this example. Before placing a market order, you should check the best bid or offer for the contract. Bid or offer for this contract can be checked by clicking on Best 5 Bid or Offer link provided on the right side of the order form. Best bid is 39.5 and the best offer is 42.8. If you are placing a market order, then it will execute at the best offer price available at market, which is Rs 42.8. Let us now allocate funds for this trade. Options trading have a margin requirement since delivery of actual asset is not taken. When you take a buy position, you will pay a premium, so the margin is limited to the premium. However, in the case of a sell position, there is no premium, and so ICICI Direct specifies a margin percentage. Let's say you want to know the margin required to sell Inftech call option. Now click on margin calculator and type Inftech for stock quote. Select options under the product drop down and click on select contract. Then we need to type the quantity and rate under sell order column for a specified contract. Here we are calculating for 30th Jan. 2850 strike call option for 125 quantity at a price of 45, and then click on submit button, which is provided at the bottom of the contract list. Margin required is Rs 46,184.25. For this example, let's take a buy position with a market order on the Infosys call option discussed earlier. The best offer price available was 42.8 and the lot size was 125. So we need to allocate 125 multiplied by 42.8, that is Rs 5,350. Mouse over the FNO tab next to the Equity tab and click Modify Allocation. Click Add in the Futures and Options segment and enter the amount that you would like to allocate. On entering the amount, click Submit. The money will transfer from the net withdrawal balance to the Futures and Options segment. Now, placing the order is quite simple. Select the product, put the relevant details and put the order. You will be taken to the order confirmation screen, which will confirm the order placed by you. The execution price can be checked through the trade book. As usual, after placing the order, you can check the status of your order in the order book. You can also modify or cancel the orders which have not been executed yet. So till now, we have selected the product, the buy or sell position, allocated funds, placed the order, and finally the order is executed. It is time we see how to square off our position. Like in margin trading, you do not take actual delivery of the security in options trading too. Or in other words, you close your open position by simply placing a square off order. Here's how you do that. You can place the square off order either through the normal buy sell page or through a hyperlink square off on the open position page. It is advisable to place cover order from open positions page through the square off link, since the quantity available is auto-populated and you are aware of the quantity for which you are placing the square off. Mouse over FNO and click Open Positions and select Option from the product drop-down. Let's say you want to square this position of Inftech 2850CE for June series at Rs 46. Now you need to click on square off and you will be taken to FNO square off page where you can view the quantity you are holding, which shows 125. Now click on limit and enter the limit price as 46 and click on submit. You will be taken to the order confirmation page where we need to click on proceed. As usual, you can view this order in the order book. In trading, I'd suggest you must keep a close watch on your portfolio as frequently as you can. Portfolio details page provides you the snapshot of your profitability in FNO segment. This page tracks your unrealized profit or loss on open positions as well as realized profit or loss for positions which are closed or squared off. Mouse over FNO and click on portfolio details. In options, a buyer pays the premium and seller receives the premium. Hence, if you're buying an option, then it will reflect a negative cash flow under realized P&L because you are paying premium. The amount you invested in options will reflect under open position value, and at any point of time, the current value as per last traded price will reflect under profit loss unrealized. The difference of these two amounts is the unrealized profit loss on that position. Let me explain you with an example. Let's say you have bought 125 quantity of Opt Inftech 2850 June at Rs 35 and you are holding this position. Your outflow would be Rs 4,375. Hence, as you have realized an outflow of Rs 4,375, this will be reflected in profit loss realized under options. Your open position value will also reflect this amount of Rs 4,375. Say the price of this contract goes up to Rs 50. As this position is still open, the current value of your position, which is Rs 6,250, will be reflected under profit loss unrealized. Let's say you have squared off, closed the position at 50, then there will be an inflow of Rs 6,250. Hence, profit lost realized column will reflect profit of 6,250 minus 4,375, which is equal to Rs 1,875. Before I leave you, I wish to make a quick suggestion. Please use our research tools and make informed decisions. You can use the charts, markets at fingertips and our research page to track the various trends and patterns in the market. Mouse over FNO and click on FNO at fingertips. FNO at fingertips is designed to offer an integrated platform consisting of all tools, information and inputs needed by an active derivatives trader. At present, you can track most active futures, top Nifty strikes, low value Nifty strikes, active stock options, high rollover stocks. Apart from these, you can also track stocks which have opened gap up and are trading above previous day's high, stocks which have opened gap down and are trading below previous day's low, stocks at 52 weeks high low and stocks where volume increased by 10%, etc. You can also view ISEC derivative research recommendations too. Similarly, Calculate Index and Know Your Margins are tools to help you in calculating your margin requirements and also the index and stock price movements. I hope you have found options trading quite like any other trade. It is simple and easy. Do write into us at the email ID mentioned on your screen with your feedback and suggestions. We look forward to hearing from you. Thank you and happy investing.